This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, June the 22nd, 2016. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates regional developments. Therefore, the slides this morning will focus on our other three report areas of the GMTP report, the global risk, macro, and U.S. economic developments. As I often do, I'd like to tie them together into a discussion on whether the next financial crisis has already begun. In this regard, I'd like to go through the following subject areas shown here in this agenda chart. We can see that the global financial stress index is strongly trending upward. This is not because of Brexit, though that has definitely been a contributor. I showed in the GMT report how the TED spread and the OIS LIBOR measures have been increasing significantly, as also the international sovereign credit default premiums. An accelerating collapse in global bond yields cannot be perceived as anything other than a clear warning signal. This is particularly true when the divergence between the stocks and bond yield is so pronounced. You can see that since the end of the Federal Reserve stimulus programs, the world has felt this impact. Nothing new for our long-term listeners. Try not to read too much into this chart, except to observe that we are seeing classic technical signs of a major long-term top being put in place. Whether it is a head and shoulders, a rounded top, or a megaphone pattern, we currently have all of them. Our subscribers are well aware that the international markets have not been performing well for some time now. There has been a particularly lot of pain since the end of the U.S. taper program, not exclusively to it though. The U.S. equity markets, because of corporate stock buybacks, have stood out against a rather dismal background. The EAFE in particular, in absolute terms, is at an important juncture in the context of its post-February intermediate term rally. We either find support here or we are heading significantly lower. In my recent 1-hour video discussion with Richard Duncan, he suggests things are only getting worse in the area. Central banks can solve liquidity problems. They simply can't solve solvency problems. We have excess debt, we have financial deleveraging, we have aging demographics, and we have technological disruption. These are most fundamentally business model solvency issues. They're not liquidity issues. That reminds me of that old adage, if you have a hammer, then everything looks like a nail. What we have most fundamentally is structural problems, and monetary policy will not fix, no matter how much money is printed, will it fix structural problems. It may possibly delay things further, but it will not fix the problems. In matter of fact, it exasperates the problems. We have had endless, well-respected authorities warning about the financial markets. They have been proved wrong. Have they all become suddenly stupid, or is something going on that few really, truly understand? Most who have studied the situation thoroughly have conceded it is because the markets are being manipulated. I won't comment on that, but I would observe that we now witness people like George Soros coming out of retirement because he believes the markets are so badly distorted. Carl Icahn is at short levels he has never done before. Something is wrong somewhere. I mentioned my video with Richard Duncan. As you can see in this chart, he is very, very clear that he believes that China's hard landing has already begun. And he points that out in a lot of these statistics, but most clearly because of the reduction in imports into China. As big as China's exports are, its imports are huge, and these imports are coming from all the emerging market nations around the world. That is impacting the world, and China is now the dominant growth engine in the world, or at least it has been since the 2008 financial crisis. I very much respect the thoroughness with which Michael Snyder does his analysis. As a lawyer, he is only interested in the facts and has authored endless reports that lay out long lists of factoids proving a particular position he has come to. He doesn't shoot from the hip, but rather lets the facts guide him. I've interviewed him quite a number of times and have very much enjoyed the sessions. And he recently wrote, and I quote, "Over the past 12 months, stock market investors around the planet have lost trillions of dollars. Since this time last June, stocks have crashed in 6 of the world's 8 largest economies, and stocks in the other 2 are down as well. The charts that you are about to see are absolutely stunning, and they are clear evidence that a new global crisis has already begun. Of course, it is true that we are still in the early chapters of this new crisis and that there is much, much more damage to be done. But let us not minimize the carnage that we have already witnessed. In general, there have been 3 major waves of financial panic over the last 12 months. Late last August, we saw the biggest financial shaking since the financial crisis of 2008. Then in January and February there was even a bigger shaking, and now a third wave has begun in June. Not all areas around the globe have been affected equally by each wave, but without a doubt this new financial crisis is a global phenomena. I'm not going to go through Michael's actual charts with you, but I referenced that you might want to have a look at them. They're pretty stunning. Another analyst I value is Lance Roberts. His charts are some of the best on the web, and Lance writes, "The Fed has lost control of the narrative and their credibility." He goes on to explain, and I quote, "The problem stems from the Fed's ongoing adherence to data dependency. Last December, when the Fed funds rate was increased, the Fed discussed the potential for further rate hikes in 2016 as inflation and employment data strengthened. However, in March, with employment and inflationary data improving, combined with a strong rebound in the financial markets, the Fed opted to ignore their data and focus on global risks to hold rates steady. The problem for Miss Yellen is while she was waiting to find the perfect balance of domestic growth and global stability, global economic weakness has now begun to destabilize domestic growth and employment. This point should not be taken lightly." Lance goes on to discuss the proven flaws with the BEA's economic growth reporting, which they just readjusted down, proving him to be correct. And I again quote Lance, "This explains why many of the numbers just didn't add up. Importantly, the current decline in corporate profits and collapse in return on equity suggests the current economic backdrop is far weaker than currently reported. Next year's negative revisions to GDP will reveal this to be the case, and that a recession will likely have started in the latter half of this year, 2016. Additionally, we are seeing clear telltales of a globalized political-centric crisis. Brexit, Brazil, Venezuela. Everywhere you look, you're seeing worsening situations with the electorate frustrated and selecting candidates and new parties that a few years ago would have been considered as on the ridiculous fringe. 6 weeks before the Summer Olympics, we have Brazil's Rio State declaring a state of financial disaster and warning Olympic attendees. We have crowds in Venezuela hunting cats, dogs, and pigeons for food in Caracas. We have 81% of the Germans saying the refugee crisis is out of control under Merkel's government, and I could go on. These are serious political issues that are now building on an economic problem that stems from a financial crisis. This is a higher level of problem. Deutsche Bank's analyst explains this chart I'm showing here on the banking industry as, and I quote, underperformance is related to low rates standing in the way of expanding net interest margins. Figure 5, shown here, puts the U.S. bank index against those in the EU and Japan in absolute terms, all normalized at 100 exactly 1 year ago. It provides a pretty convincing argument, in our view, of a substantial extent of negative rate impact on financial equities. But that is not the whole story. In early January 2016, all three lines were down 20%, well before the Bank of Japan's negative rate announcements on January the 29th or the ECB's decision to expand QE in March. Both of these events have contributed to the European and Japanese banks losing another 15 to 20% from early January levels, but they arguably have much less to do with the U.S. bank index still sitting at its earlier January levels. We believe, and again this is Deutsche Bank, that a solid share of poor U.S. bank equity performance is attributable to expectations of rising credit losses outside of the commodity sectors. Let me repeat that. Attributable to expectations of rising credit losses outside of the commodity sector. Here we see CCC rated high yield issuances on the left and in investment grade and high yield issuances on the right. Credit is tightening, and significantly. Next we see CLOs, collateralized loan obligation issuances, falling due to a shortage of leveraged loans. And the reasons for falling leveraged loans are tightening credit environment and credit standards. It's choking off this growth in CLOs, which is the basis of the shadow banking system, which was what you will remember was at the center of the 2008 financial crisis with asset-backed commercial paper. Here we see the annual rate of change of the sum of charge-offs and delinquencies in commercial loans. This is not a chart you've seen before. Believe it or not, this number is growing at a record fast pace as of Q1 2016 at 122% year over year, and it is surpassing even the rate of change peak seen near the trough of the Great Recession of 2007-2009. And this is happening with the federal funds rate target at a measly 0.25 to 0.5% corridor, and the broad money supply still growing at more than 8% year over year. The annual rate of change of the sum of delinquencies and charge-offs of commercial loans, the black line on the left-hand scale, versus the Fed funds rate, the red line on the right-hand scale, reaches a new record high. Good thing that corporate debt is growing at a blistering pace as well of late, otherwise this might get noticed. Well, who knows, but maybe buying junk bonds here isn't the best idea ever. Kind of just a hunch here, mind you. I suspect we have come to a moment of truth. This chart shows the U.S. bank stocks versus the S&P as a percent change from the 52-week high. When bank stocks fall, markets almost always fall. But I think what is important here in this chart is the two levels shown. We are at level 1. Will this trigger a central bank response or not? I'm not sure the central banks can actually afford a degradation based on the amount of leverage capital currently being employed without exposing the economy to a major and possibly uncontrollable drawdown adjustment if we were to start to head to level 2. I've got to believe the central banks are very, very worried about the degradation and the change in the credit cycle. The question we need to ask is, where are we in the global economic cycle? obviously I believe the credit cycle has turned. Normally this comes with serious ramifications for investors and the financial markets. It may trigger, as I said, the central bankers now to go full in with something like massive helicopter money. Time will tell, but we are certainly at that cusp. Let's revisit 4 charts from one of the best cycles guys in the world, and that's Harry Dent, who I had on Financial Repression Authority recently. This chart that he put together of a hierarchy of macroeconomic cycles shows here over on the right that we have a combination of cycles all coming together on a downward trend at the same time, whether we're talking about the 30-year generational cycle in blue or whether all the way down to the bottom where we're talking about the 10-year boom-bust cycle. There's too much going on all at once here. And this is another chart from Harry where he shows how we're putting in a very clear rounded top. He argues we may even see what I've referred to as an M top over here on the right hand side. He goes on and he shows this megaphone top I referred to earlier and where he thinks the markets are going. He is actually very, very negative right now. Another outstanding cycle analyst is a person by the name of Martin Armstrong, and I've mentioned him before. Martin Armstrong does something that is truly outstanding, and that is economic confidence cycle, which is shown here at the bottom of this chart. And it's showing the down waves that we can expect as we go into 2020, but certainly in 2016, 2017. What we're seeing here is what I perceive to be the end game, and that is what I've referred to as the M top. Where it breaks will depend on central bank strategies and policies and the degree to which the markets react to it. I just believe whatever level it gets to in this final ramp up, the downside is certainly on the other side of it. In closing, remember the answer will be, and I say this every month, they will print more money. It is the only answer governments and politicians will ever agree on, and it seems to be the only solution they can come up with. So invest accordingly. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been actually a better time for investing. However, it requires careful analysis, not following what has traditionally been the true and tried approaches, and to finding and locating a true financial advisor that you trust. So until we talk again, may 2016 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.